Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here is your weekly technical analysis of the Chicago soybean complex. However, before we start, I just wanted to let you know that no AI, that is artificial intelligence, was ever used in the composition, production, or recognition of any of these patterns, levels, analysis, or any related items on these, my charts. This was all authentic intelligence, all my own original work, as I think you deserve to have that. So with that,
Chicago soybeans. Now, first, a quick look once again at my longer term monthly charts. As I highlighted 11 weeks ago, there had been some very interesting actions taking place here. So the market, since as far back as the low seen in August 2024 till October 25, built a sideways action. I noted this action 51 weeks ago, almost a year ago, and I'll expand on that part shortly. But I just wanted you to see that this sideways action had a breach on the upside in October last year and a second more serious breach in January this year, with February's bullish closing long white Mariposa pattern making the highest monthly close since May 2024. And what is more, a close over the declining Mauve 3-year moving average, currently 1145.5, which had capped the rise back in November last year. I'd previously cautioned about the possibility of a longer term false break on the upside. But with that close over the 3-year moving average, that warning is now severely diminished and virtually non-existent. We must now look at what will be next. For starters, this now places strain on the major longer term pattern here on this monthly chart, which is the 2020 to 2024 very large head and shoulders top pattern type. You can see the bright red neckline highlight over this pattern overhead, currently at 1214.5. And importantly, you can see the targets below for this pattern of a primary target X down in the 907 zone and a secondary hardest reach target X1 is down in the 624 zone. Please note these are very, very long-term targets and should always be considered thus, but the actions in moving higher once again, especially as now prices are overcoming the November 2025 high 1172.5, well, such a move will put the bright red neckline above into the market's frame. Back now to my daily charts, and you can see that same bright red neckline not too far above the market now on my daily chart. So, late last week prices pushed up over the November 25 high at 1172.5 and have tried establishing over this level. However, though we have spent time over 1172.5, we still, as yet, have not closed over it. This must be the first order of business, consecutive closes over it, if the bullish incentive is to be maintained. However, as I said last week, and I quote, we have nevertheless formed a small bull channel over the last 3 weeks. So that's now 4 weeks, end of quote. And that's currently 1148 to 1177. This bull channel has been the most recent driver of the market. So what have we in the way topside? Well, prices have had a problem with the July 24 high at 1170, similar to the November 25 high. The market has pushed up over it a number of times, but we have barely had one close over it. Additionally, the 2021 low at 1181 has capped prices, and we haven't even tried up as yet to the May 23 low at 1193.25. However, all these may seem as nothing when compared to the rising dark blue middle time above, which is currently at 1206.25, which is now just a little short of the previously mentioned bright red neckline above. Now, it may be just me, but if you're going to punch through those two seemingly major resistances, then it would seem a good time to do it is when they are close together, and that is what will happen when they cross in about 2 weeks' time. So it'll be interesting to see if they combine to cap prices or else are taken apart together. Chicago soybean meal. The market halted its autumn decline just under the gold flatlining long moving average, currently at 294.5. down at the congestion at 290.80, which is within the big old April to August 2020 congestion, between 282 even and 300 even. I said about this congestion zone 11 weeks ago, and I quote, "Is this enough to hold it? I'm not sure, but it's enough to make the market think about holding." End of quote. This whole December 25 to January 26 move down left us with some interesting possibilities, as the whole mid-December action could be regarded as either a bear channel or a possible descending, expanding wedge pattern. Well, prices have since broken up out of both ideas on the upside, halting for a while at the significant dark blue trendline extension, currently at 312.90, of the July to September 2021 descending triangle. 4 weeks ago we saw a drop down for some fresh ammunition before turning back up. The move higher reached the primary, secondary and even the tertiary targets topside. Prices rose even higher last week but ran into trouble with a combination of the 50% Fibonacci line of the May 24 to July 25 move at 326.20 and the bright red middle time currently at 327.70 of the newly drawn bright red late September 25 to mid-January 26 bullish shift pitch walk. And this week they dropped back below the significant dark blue trendline extension, currently at 312.90 of the July to September 2021 descending triangle. Prices now are seemingly looking to test the rising mauve medium moving average below, currently at 306.50, and maybe the green flatlining short medium moving average, currently at 304.30, though at the moment they seem to be a bit wary. Now, this move lower also negates my idea last week of a possible small February based ascending triangles wedge pattern, currently at 314.40 to 319.80 as prices, which last week looked like they might try and reach the potential topside targets for such a pattern, of a primary target X2 up in the 328.5 area and a secondary hard to reach target X3 up in the 334.80 area. Well, these targets will now be retired after this commentary. Finally, this commentary would not be complete without my discussing a portion of my commentary which I have repeated now for 143 weeks. So coming up now for 3 years. It is the annual key reversal seen here at the end of 2023. I said back then, and I quote, "And I only need to remind you once again of my words when I pointed out that Chicago soybean meal was about to have that rarest of patterns, an annual key reversal down. This duly came about at the end of 2023. I've been living in the shadow of this pattern ever since." End of quote. I've also added ever since, and I quote, "If there is only one thing to take away from any of my musings, there have been those words. For nearly 3 years, the shadow of that pattern has darkened the skyline of this market ever since." Chicago soybean oil. 14 weeks ago I said, and I quote, "For all the activity in the soybean complex, it was time I finessed this daily chart to show a better and clearer view of what's going on. Thus the key pattern here is the newly expanded, sorry for the pun, the newly expanded dark blue April to date, so that is April last year to date, April to date ascending expanding wedge pattern. Currently, 54.50 something or other to off the top of my daily chart." End of quote. This pattern, specifically the dark blue lower trend line, we had until mid-December last year acted more as an attractor than an ascending expanding wedge pattern. However, back in September/October last year, the market started growing a new pattern, a bright red mid-October to mid-December expanding wedge pattern. Neither an ascending nor a descending, just an expanding wedge pattern, highlighted in bright red on my daily chart, currently 47.33 to 54.88. Now, you could argue that this was a complicated double or even triple bottom, and I could see your point. It is just that I favoured the expanding wedge pattern as a better fit for the market's actions. As a result, we have now what I set out to do right at the beginning of this section of commentary, and that is to, and I quote, "to show a better, clearer view of what is going on," as this bright red expanding wedge pattern has been just that. 6 weeks ago we closed above the bright red upper trend line, and I said 5 weeks ago, and I quote, "Primary potential will be up in the 57.10 area, for secondary harder to reach potential up in the 59.05 area." Since then I finessed them into the primary target at 58.10, which was reached 3 weeks ago, and a harder to reach secondary target up in the 60-10 area. 2 weeks ago that was reached. Now, that was not all, as there has been some further progress in this pattern, such that I added 3 weeks ago a further pattern and target idea of a bullish halfway hesitation, with a separate target up at 60 and a quarter, 60 and a quarter area, which was reached last week. So what now? Well, in the process of moving higher, we have a new February-based and quite acute dark blue bull channel, currently 61.82 to 64.29. This has been the current driver for higher prices, overcoming last week the bright pink middle sign, currently at 60.94 of the March to August 25 bullish Andrews pitchfork, as well as the old 2011 high at 61 even. Then the bright green upper tine this week has been overcome, currently at 63 even, the shallower bullish shift pitchfork with the same move as the bullish Andrews pitchfork, which by the way looks like it will be retired if we close us anywhere around here. It will be retired after this commentary. This was followed by moving up over the important 50% Fibonacci line for the big fall, the April 22 to August 24 move at 62.86. And up through most of the congestion seen between July and August 2023, between approximately 62.5 to 65 even. This last one to me is the least effective of those three, but it was still there. Last week it seemed we would be entering a significant resistance area from 62.5 onwards, upwards. Well, we did, and the market has really sliced through it, such that above the last of that congestion we have really nothing much until the August 23 high at 67.14, which is above the market at the moment. And really only see some congestion starting at the old June 2008 high at 68.13. Now I will double up that channel to give a potential secondary channel on the top side next week. But I'm just curious, I think it will probably move straight up to that August 23 high, because we are basically, if we can close here above that 65, 62.5 to 65 congestion area.
Thank you for watching and listening. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted both at the front and at the back of this broadcast. Copyright is Eddie Tofpik and ADM Investor Services International Limited. And here comes the final important bit.